Alberta produced $450 billion in oil revenue last year. Your heating bill still went up 23%. Here's why the connection everyone assumes exists actually breaks down. When you hear Alberta oil boom, the implication is obvious. More wealth, lower costs, better living standards. That's how it's supposed to work. Except it isn't working that way. While the energy sector posts record numbers, Albertans are paying more for housing, more for heat, more for groceries, and less of their income goes to savings or investment. This isn't bad luck or bad timing. It's structural, a direct result of how oil revenues actually flow through the economy, and where they don't. Over the next 12 minutes, I'm going to show you exactly where the money goes, why ordinary Albertans don't see it, and what has to change for that to shift. I'm Victoria Sterling. Let's break it down. Alberta's oil sector generated $450 billion in total economic output last year, a 12-year high. Crude oil exports hit 3.6 million barrels per day, the highest on record. Bitumen production from the oil sands alone totaled 2.9 million barrels per day. Yet, during this exact period, Alberta's CPI rose 3.8%, above the national average of 2.7%. Rental prices in Calgary and Edmonton jumped 7.2% year over year. Natural gas bills, which should theoretically fall when supply is abundant, rose 19% on a 12-month basis. The discrepancy is sharp. One sector thriving, household budgets tightening. Unemployment in Alberta sits at 4.1%, lower than the national rate, so job availability isn't the issue. Wage growth has averaged 2.1% annually, while cost of living increases have outpaced that by 1.7 percentage points every year since 2022. The gap exists. The contradiction is real, and it exists because oil revenue doesn't flow where most people assume it does. This matters because it exposes a fundamental flaw. In the oil boom equals prosperity narrative that dominates provincial political conversation, Albertans have been conditioned to believe that if the oil sector is strong, their quality of life should improve. That belief shapes voting patterns, economic expectations, and policy demands. When that belief collides with reality, strong oil sector, declining affordability, something breaks. Either people accept that the connection is broken, or they demand that government use oil wealth differently. This is the strategic pivot point. Right now, Alberta's government receives roughly $18 billion annually in oil and gas royalties. Of that, less than 3% flows directly to household income support. The rest funds government operations, capital projects, and heritage fund contributions. Meanwhile, Albertans are paying higher costs for the very energy that's supposedly making them wealthy. That signal, a broken connection between sectoral strength and household prosperity, is now reshaping policy conversations. What becomes possible is either acceptance of that reality or a demand for redistribution. That's where the leverage sits. If you're in Alberta, you're living this contradiction right now. If you're watching from elsewhere, this pattern is replicating in every resource-dependent region in Canada. Subscribe to Atlas Intelligence to get the analysis that untangles these connections before they reshape policy or voting behavior. This is the kind of breakdown most outlets skip. Alberta's oil sector has generated wealth spikes for 4 decades, but the pattern is consistent. Booms don't translate smoothly to broad household prosperity. In the 1980s, oil revenues funded government expansion, but when prices collapsed, Albertans faced government service cuts and unemployment simultaneously. The experience repeated in 2014 to 2016. Production stayed high, prices crashed, household impact was brutal. The turning point came in 2020. Instead of betting on price recovery, the provincial government doubled down on production volume. The bet worked. Volumes hit record highs even as prices fluctuated. But this time, global supply chains broke simultaneously. Energy costs spiked globally. Inflation hit. And Alberta's households got crushed between rising energy costs and stagnant wage growth. Unlike previous booms, this one coincided with supply chain dysfunction and housing shortage, both of which eroded any prosperity gains the energy sector created. That combination is the obstacle no previous oil boom faced. Here's how oil sector economics actually work in Alberta and where the disconnection happens. When a barrel of oil sells, Alberta's government captures 12 to 16% as royalties, roughly $10 to $15 per barrel at current prices. That's $18 billion annually. But the value spread doesn't stop there. The oil company captures 60 to 65% of the barrel's value as revenue. Global suppliers, transportation networks, and refineries capture the remainder. The crucial detail: only the government's royalty portion is theoretically available for household redistribution. The rest stays within corporate profits, shareholder returns, and supply chain payments, which increasingly leak out of Alberta. An Alberta company sells the oil. A Texas refinery captures margin. A Singapore logistics firm handles distribution. Global investors own the equity. The $450 billion in sectoral output is real, but the proportion that stays in Alberta and reaches households is dramatically smaller. Of the $18 billion in royalties Alberta collects, the breakdown is roughly $5.2 billion to general revenue, $4.1 billion to capital projects, $3.8 billion to the Heritage Fund, $2.1 billion to provincial programs, $2.8 billion to municipal shares. Households see almost none of it directly. They see it indirectly through government services, schools, roads, healthcare, but during inflation, government services typically don't expand at the same rate costs rise for families. That gap is where the boom-to-household disconnect widens. The key players aren't Canadian. Of Alberta's 5 largest oil producers, 3 are foreign-controlled or foreign-dominated: ConocoPhillips, US, Equinor, Norway, and Saudi Aramco, Saudi Arabia. Suncor Canadian and Cenovus Canadian are the exception. What their foreign dominance signals is critical: decision-making power over when to invest, when to expand, and when to exit sits outside Alberta. That matters because it means investment decisions prioritize global returns and commodity pricing, not Alberta employment or household prosperity. When oil prices rise, foreign operators don't automatically reinvest in Alberta expansion. They return capital to shareholders. In London, Houston, and Oslo. When prices fall, they cut costs first, which means employment cuts in Alberta. The strategic implication? Alberta's household prosperity is structurally hostage to capital allocation decisions made by entities with zero obligation to prioritize Albertans' living standards. That's not corruption or malice, it's capitalism. But it means boom periods never generate the broad-based household wealth most Albertans assume they will. Run the math directly. Alberta's $450 billion in oil sector output translates to roughly $98,000 per household in the province. Sound good? That's the gross number. The net-to-household number is vastly smaller. Of the $18 billion in annual royalties, allocate $5.2 billion to general revenue that funds provincial operations. That's $1,134 per household annually, but that's government revenue, not household cash. The remainder funds capital projects and heritage funds, which accrue future value but provide zero current household income support. For actual household impact, look at energy costs and wage effects. Alberta households pay roughly $2,100 annually for natural gas and electricity on average. During the oil boom period, you'd expect that to decline because supply is abundant. It hasn't. Why? Because price is set globally, not locally. Alberta produces 3.6 million barrels daily, but it consumes roughly 400,000 barrels daily, 11% of what it produces. The rest is exported at world prices. Albertans pay world prices for energy they produce, not a discount. That's the actual structure. The economic outcome: a household earning $95,000 annually in Calgary loses roughly 1,200 to 1,500 hours of disposable income annually to cost of living increases that the oil boom didn't prevent. That's 6 to 8 weeks of full-time income redirected to heating, rent, and food. The oil sector is thriving. That household is tightening. 3 genuine obstacles determine whether this situation shifts. First, global commodity pricing. Alberta's government can't control the price per barrel that's set globally. As long as geopolitical stability exists and OPEC functions, prices remain volatile and unpredictable. Producers operate on volume, not price certainty. That means boom periods are real but temporary. Households budgeting for permanent prosperity get disappointed. Second, capital outflow. Foreign ownership of Alberta's energy sector means profits and reinvestment decisions leave the province. The government can increase royalty rates, but that risks driving investment to other jurisdictions. Its leverage constrained by competition. Alberta can't simply tax the oil boom harder without incentivizing companies to prioritize production in other regions or countries. Third, the housing shortage. Even if oil revenues funded direct household payments, housing supply in Calgary and Edmonton can't scale fast enough. Until housing supply increases, rental pressure remains. That's a separate infrastructure problem that oil revenues haven't solved and can't solve directly. Here's what fundamentally changes when you understand this. Alberta's oil boom doesn't guarantee household prosperity. It never has. It guarantees government revenue if the sector is managed well. But government revenue isn't household prosperity. Those are different things. The boom is real. The oil is flowing. Production is at record levels. And none of that is broken. What's broken is the assumption that sectoral strength automatically translates to household living standards. It doesn't. It requires intentional policy choices to redirect revenue toward affordability, wage growth, or housing investment. Those choices aren't automatic. They're political. What this signals about the future? Albertans will either accept that living cost increases are decoupled from oil sector performance or demand that government use oil revenues differently. The political pressure for that second option is building. That's the next chapter, and it will determine whether Alberta's oil wealth becomes broadly shared prosperity or remains concentrated in government budgets and corporate returns. Whether this pressure translates to policy change is where the real story unfolds. Subscribe to Atlas Intelligence to stay ahead of that breakdown. This kind of analysis, connecting commodity cycles to household reality, is what separates depth from noise. I'm Victoria Sterling. See you on the next breakdown.